Momentum looks active, but distance is not holding. Volatility keeps expanding inside overlapping session structure. The chart still looks busy. Price moves quickly from one side to the other. But the center of the move has not changed. That center is the weekly 0.33 area. Not because the number itself is special, because recent sessions keep forming above it, below it, and directly across it. That is what gives the level weight. This is the first thing that matters in a session-centered framework. A major area becomes important when later sessions keep inheriting it. That is exactly what this chart shows. If the week has been followed through session boxes, the behavior is clear. Price does not leave this area and build lasting distance. It keeps returning to it. That is why April 1st is not isolated. It belongs to the same compression sequence. The meaning of weekly 0.33 on this chart is simple. It is acting as a working center for repeated session overlap. When price reaches above it, older memory pulls it back. When price reaches below it, the same memory slows continuation again. That is not prediction. That is repeated structural consequence through time. This is also where the second important point becomes visible. Session-based boxes do not usually appear in clean, empty space. They usually appear where earlier session memory is already active. Sometimes directly on a prior session boundary. Sometimes between the upper side of one session and the lower side of another. Sometimes across a cluster of levels that have already been tested several times. This chart had many of those earlier memory points removed for visual simplicity, but the behavior still exposes them. The reason a later session forms where it does is usually that earlier acceptance or rejection already happened there. That overlap is what creates friction. It is what creates compression, and it is what causes price to look active while still failing to leave the same area. Now go into March 31st. The March 31st U.S. session formed exactly between the upper boundary of the March 30th Asia session box and the lower boundary of the March 30th U.S. session box. That placement was already tight, but the compression was deeper than that. That same upper area also aligned with the upper boundary of the March 27th U.S. session. It also aligned with the upper side of the March 29th Asia session. So the session did not form between only two recent references. It formed inside a stacked memory zone. And that stacked memory zone sat near weekly 0.33. Now the five axes can be seen through one structure. Session remains the anchor because the whole box is defined by inherited session levels. Volatility remains active because candles still travel. Position remains unresolved because price does not hold away from the center. Pressure remains unstable because neither side sustains continuation. Interaction remains intense because the same boundaries keep getting tested again. That is why the environment does not behave like open trend. It behaves like recurring friction. Pullbacks extend deeper before stabilizing. Continuation attempts stall earlier. Reaction becomes faster and less stable. Distance expectation compresses. Failure frequency increases. Holding pressure rises near both edges of the box. If overlap continues around weekly 0.33, distance remains limited. If one side begins holding outside the stacked session memory, tolerance must widen. The environment is still being defined by return, not escape. Price looks like it should continue. But continuation keeps running into older session memory. That contradiction becomes clear when the previous day is reviewed first. The March 31st U.S. session did not form in open space. It formed exactly between two already active references. Above was the upper boundary of the March 30th Asia session box. Below was the lower boundary of the March 30th U.S. session box. That alone already created a narrow working range. But the actual structure was tighter than it first appeared. The upper side of that March 31st U.S. session also matched the upper boundary of the March 27th U.S. session. It sat in the same region as the upper side of the March 29th Asia session. That means the session was born inside repeated overlap. This is the kind of placement that matters most in the MRM session framework. When a new session-based candle forms inside earlier memory rather than away from it, the chart is already telling you that continuation has less room. The move can still happen. Volatility can still expand. But distance has to fight through prior memory almost immediately. That is what happened here. After the March 31st U.S. session formed, price first tested the lower boundary of the March 30th U.S. session box. That test matters, because price did not ignore the lower side. It went directly to it. Then later it tested the upper side as well. That is not clean directional behavior. That is the behavior of a box that is being used as a compression chamber. One side is exposed. Reaction appears. Then the opposite side becomes active. And because both sides are tied to older session memory, neither test becomes easy continuation. This is where the importance of session memory has to be stated clearly. A session box is not useful only because it shows one local range. It is useful because it usually sits on inherited structure. That inherited structure is what determines whether a later session can extend or whether it has to recycle. If earlier memory is dense, the new session cannot travel freely. It has to negotiate. That is the reason these placements should be studied repeatedly. The chart may seem simplified after older lines are removed, but the base candles still reveal the memory. Why did March 31st form there? Because earlier session boundaries were already stacked there. Why did the lower side remain active? Because the lower boundary of the March 30th U.S. session had already become a working edge. Why did the upper side remain active? Because the March 30th Asia upper boundary and the March 27th U.S. upper boundary were already sitting there. This is not decorative overlap. It is operational overlap. Now bring volatility into the same structure. The white band shows that movement is still real. The chart is not dead, but the width of movement does not create stable relocation. It creates bursts. Then return. Bursts again. Then return again. That is why behavioral friction becomes more important than visible candles. Moves fail to hold distance. Continuation attempts stall earlier. Retracements reach deeper before stabilizing. Reaction speed increases at the edges. And as reaction speed increases, tolerance becomes narrow. That is where execution conditions shift. The chart stops rewarding broad distance expectation. It starts rewarding awareness of boundary exposure and failure frequency. If compression remains centered around the same stacked session memory, distance stays limited. If displacement begins holding outside both edges of the working range, holding pressure can ease. The March 31st U.S. session did not resolve that question. It only exposed it more clearly. Price is moving again, but the market is still trading between anchors. That is what April 1st is showing. The April 1st structure continues to work around the same center that has already been exposed by the recent sessions. The upper side remains tied to the March 30th U.S. session upper region and the nearby stacked memory above it. The lower side remains tied to the March 27th U.S. session lower area and the weekly 0.33 center nearby. So even when price moves, the move is still being measured against earlier session anchors. This is why the chart title Trading Between Anchors fits the current environment. The movement is visible, but the visible movement is still happening inside inherited session control. Now focus on the April 1st behavior itself. Price pushed lower again into the lower side near the March 27th U.S. session boundary and the weekly 0.33 area. That lower region was not empty. It had already been used before as a return point. So when price reached it again, reaction appeared again. Then price lifted back toward the Asia 30 and US 31 overlap region. That upper area also was not empty. It had already been used as a working edge. So the same chart is doing the same thing again. The market leaves one anchor, reaches the other, then loses distance again. This is where the meaning of weekly 0.33 becomes even clearer. It is not only a higher timeframe reference sitting beneath the chart. It is functioning as a practical compression center for the current sequence of session anchors. The lower boundary activity keeps clustering around it. The upper boundary activity keeps measuring itself from it. That is why the level matters. Not because price touched it once. Because multiple sessions keep organizing themselves around it. Now the full structural contradiction becomes simple. Perceived reality says price is moving and volatility is active. Structural contradiction says the move still cannot leave the same overlap for long. Visible structure says the sessions keep anchoring themselves to prior memory. Behavioral friction says continuation stalls earlier, pullbacks deepen, and reaction becomes unstable. Execution condition shift says distance expectation must compress while failure frequency stays elevated. Then the chart gives the conditional frame. If April 1st continues to trade between the same lower anchor near weekly 0.33 and the same upper overlap zone near the recent US and Asia boundaries, distance remains limited. If price begins to hold outside one side of that anchor range and stops returning immediately, tolerance must widen and the behavior changes. That change has not happened yet. What is happening now is repeated inheritance. The March 31st US session inherited stacked memory. The March 31st Asia session continued to process around the March 30th US structure. The April 1st behavior is still being judged by those same anchor points. That is the repeatable lesson. A session-based candle is rarely independent. It usually forms where earlier memory is already alive. That is why the locations matter so much. They show where the next session will inherit friction before the move even develops. And that is why this chart still does not feel aligned. Momentum appears, but continuation does not settle. Volatility moves, but distance does not last. Price reaches an edge, then returns again. Execution conditions remain in transition.